Good evening, everyone. I welcome you all to today's webinar on the future of stakeholder engagement, evolving trends, and their impact on corporate strategy, organized by the Committee for Member in Industry and Business of the Institute of Chartered Accountants of India. We have with us the chairman of CMIB of ICI, CA Dr. Anuj Goyal ji, and in absentia, Vice Chairman, CA Rajesh Sharma ji. The committee for member in industry and business is one of the non-standing committees of ICAI. The major activities of the committee are campus placement programs for newly qualified CAs, career ascent for experienced CAs, overseas campus placement program, MDPP for rank holders and general members. Now, a brief about the chairman of CMIB, CA Dr. Anuj Goyal ji. He's into practice and he's a Central Council member of the Institute of Chartered Accountants of India. He has made significant contributions to the profession with his extraordinary tenure of 19 years in Central Council, 3 years in Regional Council, and 6 years in the branch. He's currently the chairman of CMIB and TAQRB, as well as the deputy convener of Publication and Sales Directorate. He's a goal-oriented man having a vast experience of 30 years. Now, a brief about Rajesh Sharma ji, who's the vice chairman of CMIB. He's a distinguished chartered accountant in India, recognized for his extensive contribution to the profession. He has served multiple tenures as a Central Council member of the Institute of Chartered Accountants of India. Throughout his tenure with ICI, he's been involved in various committees and initiatives aimed at enhancing the standards and practices of the accountancy profession. Now, I would like to invite CA Dr. Anuj Goyal ji for his opening remarks.
Thank you, CA Gaurav Maniji, our honorable moderator. We are having very important topic today. The future of stakeholders engagement, evolving trends, and their impact on corporate strategy. I welcome all our honorable members from each and every part of the country, outside country, on behalf of Institute of Chartered Accountants of India, on behalf of Committee for Members in Industry and Business. We are having our honorable secretary of the committee, C. Anita Suneja ma'am, along with her entire team. And of course, we are having today's guest speaker, C. Kuldeep Kothari ji, who is going to speak on a very important topic, the future of stakeholders engagement, evolving trends and their impact on corporate strategy. Friends, you must be very well aware that this committee for members in industry and business, we are trying to see that how we can really do something very concrete for the members who are in industry. And at present, around 60% members are in industry, and newly qualified chartered accountants, I think 80% of them are joining industry. And now you are very well aware that we are having examination 3 times, so we will be having the campus placement also thrice. So we are putting our best to see that the best accounting professionals across the globe, how we can try to matchmaking and can try to see that the trade and industry where the chartered accountants are in great demand, not only in India but outside India also. How we can try to have the campus placement with the help and support of our own chartered accountants who are at the key managerial positions, as well as we are continuously interacting with the HRs in the industry, not only in India but outside India also, so that we can make available the best of the accounting professionals of the world, the members of the Institute of Chartered Accountants of India. And you must be very happy to know that we have taken one very important initiative for the women chartered accountant, how we can try to understand their problem and how we can made available the women chartered accountants who are further better chartered accountants, and how we can understand their problems also. And now after corona, more particularly, the work from home is a buzzword. So the women who want to try to adjust their work life balance, they are having the family responsibility also. So how they can be engaged in the industry through our initiative. On 25th of this month itself, we have started that women campus placement program, in which we will be focusing the work from home also, flexi hours also. So I will request all our honorable members who are in industry, all our honorable viewers, to please use their good office to see that how we can engage the women chartered accountants also. And then on from 1st of May, we are starting for those chartered accountants who are experienced, maybe having the experience of 30 years, 25 years, 10 years, 5 years, 4 years, and that career ascent, and that very very dedicated job portal, that platform 24/7, that would be available for the members also, and for the trade and industry also across the world. And we want to see that how we can provide the best of the platform for the members who want to switch one industry or another, and even those who are in practice, they want to be in industry later on, can also be the part of this career ascent. A lot of initiative we are trying to have, and we are trying to see that how we can really do something very very concrete for the members in industry. We are having regular webinars, and today's topic is very very important for all of us in today's dynamic and interconnected world. Stakeholder interaction is central to sustainable success, no longer a residual activity and more than a mere exercise. A robust stakeholders engagement is a strategic initiative fundamental for responsible business operation and lasting value creation. And the shift is mainly driven by societal expectations and ESG factors. The corporate world is rapidly shifting towards a broader holistic approach embodied by the double materiality assessment. But it is important to understand that double materiality is not the same as ESG materiality, and stakeholder engagement doesn't mean engaging with only internal stakeholders. While India's BRSR framework doesn't mandate a specific methodology for stakeholder engagement and materiality assessment, its requirement to report the financial impact of material issues suggests an intent towards double materiality. International frameworks like CSRD prescribe formal standards for conducting stakeholder engagement and double materiality exercise. These changes are significantly shaping corporate strategies and, more importantly, impacting the creation of long-term value for both businesses and society. So we are having very, very prominent resource person who is going to discuss with all of us the future of stakeholders engagement, evolving trends and their impact on corporate strategy, C. Kuldeep Kothari ji. And I'm quite confident with the help and support of all of you, we will certainly be trying our level best to see that how we can do something very, very concrete for the members in industry. I once again welcome all of you on behalf of ICI and on behalf of Committee for Members in Industry and Business. Thank you very much.
Thank you so much, sir. We have with us CA Kuldeep Kothari ji, who's the speaker for today's session. He's an highly accomplished chartered accountant and a national rank holder in both CA and CS examination. He brings with him over 13 years of extensive experience in financial reporting, regulatory compliance. As a co-founder of Advin Advisory Private Limited, he specializes in integrated reporting, ESG reporting, and Ind AS. A fellow member of the Institute of Chartered Accountants of India. He holds qualification including CS, LLB, DSA. He's a certified concurrent auditor, certified course on financial markets and security laws, and is also a certified forensic and a social auditor. He's impaneled with Institute of Chartered Accountant of India as a peer review and a head technical reviewer for the financial reporting framework, and he's impaneled as a technical reviewer with FRRB and TAQRB. He's a principal researcher of research study on application of revised formats for financial statements in educational institution and impact study. He's also an author of books on investor awareness and financial topics for the Institute of Chartered Accountants of India. He's a co-author of compendium of case studies on excellence in financial reporting and commonly found errors in financial reporting. And he's a keynote speaker on various topics on financial reporting framework and practices, SEBI, LODR, INDES, integrated and ESG reporting. Now I would like to invite CA Kuldeep Kothari ji to share his knowledge with us and enlighten us today.
Thank you, Gaurav, for such a warm introduction. I extend my heartfelt gratitude towards the chair of the committee, CA Dr. Anuj Goyal sir, for giving me this opportunity to interact with all of you again and again. And it's the holistic thought and approach of leadership with which we have identified these key important topics to be discussed with those who are working in industry. Reason being, the first session in the series of these webinars was related to accuracy of ESG disclosure. Then we discussed about new best practices in reporting frameworks, integrated BRSR, etc. So we believe that a chartered accountant who is working in industry or who is working in the capacity of a CFO or in capacity of any KMP, he is the most acute person to take care of all 360-degree functions of the organization as a whole. And that's where stakeholder engagement and materiality assessment comes into play, because it is not a compliance thing, it is not a process, but it is something which serves as a strategic tool of communicating the thought or the concept or the business model of the entity to those who are related. And very importantly, it was mentioned by Chairman Sir also, that stakeholder engagement is not limited to engaging with internal stakeholders. It is very important. Yesterday only I was having a discussion with an compliance team of a listed entity, and they were of the opinion that see, we only engage with the process owners, so they were mixing materiality assessment with risk management. And I would like to point out specifically this thing, that risk management and materiality assessment are two different facets. They are not related to each other in any manner whatsoever. And why it is so? Because risk management is coming out of the traditional ERM framework, or it is a function which is predominantly related to internal controls, internal audit, etc. Where you talk about materiality assessment, it focuses on material issues. So issue can be a risk, an issue can be an opportunity also. So coming back to the same thing which we were discussing, so they were of the view that, see, why we will discuss anything with someone who is not connected to our entity. And they gave an example that आपके घर में झगड़ा है, आप नेबर से जाके थोड़ी पूछोगे कि भाई मेरे में क्या प्रॉब्लम है. But that is not the correct approach, because see, when you talk about and when you categorize and when you identify stakeholders, you will figure out that maximum of the stakeholders who are related to your value creation process, who are impacted by your business model or influenced by your business model, or vice versa, they are influencing or they are impacting your value creation process, they are external stakeholders. Stakeholders are not limited to investors. Stakeholders are not limited to employees. Stakeholders are not limited to shareholders. Stakeholders are not limited to management committee members or board of directors. They are as vast as industry and peers, rating agencies, regulators, policymakers, your downstream and upstream value chain partners also. So we'll try to figure out in next 1 hour 30 minutes that what actually stakeholder engagement and materiality assessment have in line for us, what we can do as a chartered accountant. Do we have something new to excel upon, or is there any new opportunity also? Because it is very important, it is imperative to discuss. See, if I discuss only frameworks, it will not make any sense. There has to be a final outcome for which all of us have gathered in this webinar in large number. So we'll discuss that how practically one can form a stakeholder engagement and materiality assessment approach, why it is important. So why it is important and how it is important, what matters, and how it is relevant to your strategic initiatives and value creation process. So I'll take a second to open the presentation for today's session. Hope it is visible on the screen. So as the topic of today's session suggests, future of stakeholder engagement and evolving trends and their impact on corporate strategy. So we are required to have an intricate assessment as to what stakeholder engagement means. Point number one. Point number two, whether it is a process or it is a necessity in terms of having good communication with your stakeholders. Point number three, that is it limited to doing financial materiality assessment or engaging with the stakeholders, those who can directly or indirectly influence your bottom line or top line? Point number four, what do we understand by traditional approach of materiality assessment? Point number five, that whether there is any specified framework which has been given or which has been prescribed in any of the reporting frameworks relating to how a stakeholder engagement is required to be done, whether there is any specific methodology which is required to be followed. So these are few buzzing topics or point of discussion which is there in corporate industry per se. Because by doing effective stakeholder engagement, not only you are complying with something which is given in the framework, you are building trust, you are building credibility, you are creating brand awareness, and you are indeed you are able to incept what actually is relevant for those who are related to your value creation process, how you are responding to this whole scenario. So there are a lot of things which is required to be discussed in view of present trend, which has completely shifted to, as rightly said by Anusar also in his opening remarks. So the focus has shifted to double mortality assessment from single mortality. So we all hear this mortality word, and I'll take few minutes to clarify that what kind of mortality we are discussing, and you will be able to appreciate this thing that see, as a professional or as a chartered accountant, we often hear about mortality in financial statement. So that is altogether different from what we will be discussing today. One is mortality in terms of your audit processes if you are from auditor side. So if you can recollect, if you do audit, you do sampling also, and you apply the concept of mortality, whether something is financially material, if it is crossing a certain threshold, whether it is relevant for the stakeholder, whether it is relevant for an auditor to assess also. Then comes the second mortality, which is related to Ind AS only. Very important change which we discussed in our last webinar also. It is pertaining to disclosure of material accounting policies. So previously what used to be the case, that companies used to disclose significant accounting policies. As of now, this change is applicable on the entities on which Ind AS is applicable, that is Indian accounting standard is applicable. But this is again, it was misconcepted and it was misunderstood by many of us only, that it is similar to financial mortality what we used to assess during our audit process, or what we used to assess while preparing the financial statement also. So that materiality threshold is completely different, and that material accounting policy information threshold is completely different. Then comes the materiality number three, that is the talk of town in past few years. And SEBI LODR, if anyone of you is working in a listed entity or related to listed entity in any manner whatsoever, SEBI LODR has been a roller coaster ride in past few years, and we often discuss mortality in SEBI LODR also. So then again, when this SEBI LODR mortality came into place, it was misunderstood with the mortality which was earlier there in financial statement, then the mortality in Indian accounting standard related to disclosure of material accounting policy information. So then the third materiality which we just discussed is related to SEBI LODR. So what it is, is it similar to setting up an quantitative threshold? Yes, because when disclosure of material accounting policy was concerned, material accounting policy, it was related to carrying out an materiality test or litmus test of sex conditions. But when it came to disclosure of material events and information, so there was a lot of subjectivity in this particular domain. And the focus of the prime regulator SEBI is on promoting transparency, governance, and asymmetry of information, reducing asymmetry of information. So, to promote transparency and good corporate governance, what they've done, they've taken out the subjectivity from disclosure of material events and information, and now they've introduced an objective threshold. So, objective threshold is 2 to 5, 2% of the average turnover past 3 years, consolidated annual turnovers, 2% of your absolute 2% of your net worth, in which negative net worth is excluded, 5% of your profit after tax, absolute value, in which losses are also included. So 2 to 5 rule was introduced to eradicate the subjectivity out of SEBI LODR's material events and disclosure related domain. Then there is value and impact in terms of value. So this is a altogether different topic, so I'll not touch upon this because we'll have a separate session on this. But why I wanted to clarify that these three materiality assessment or materiality matrices are different from what we will be discussing today. So comes the materiality assessment number 4, and that is where lies this whole discussion of stakeholder engagement. Because if you want to carry out a mortality assessment, whether single mortality assessment or whether double mortality assessment or ESG mortality assessment as they call it is imperative to engage with your stakeholders who are internal to your entity, stakeholders who are external to your entity. And coming forward in this session, we will discuss the concept of double mortality, and when we will come to know that stakeholders are further bifurcated into two parts: affected stakeholders and then users of the financial statement. So to do a comprehensive mortality assessment, whether single, double, or ESG mortality assessment, it has to be a case that you engage with your stakeholders in effective and in a transparent manner. Because until unless you engage with your stakeholders related to respective processes and impacted and influenced by your business model or vice versa, I will not be able to figure out that what actually matters to your entity. So coming forward, we will discuss how to conduct a stakeholder engagement. Then we'll come to our question number second, that whether stakeholder engagement is something which is prescribed under any law. Is there any specific set of methods which are required to be followed when you conduct a stakeholder engagement? Or as often we all go through kind of survey questionnaire, our survey questionnaire is the only way out you communicate or you interact with your stakeholders. So before this, let us understand why it is important. Though we have discussed a few of its, its embedded opportunities, or its embedded, importance, but it is important for us to discuss why it matters to an entity in present dynamic corporate landscape. Because somebody might say that it is a monotonous process and it is not as important as carrying out any finance function. So if you have read any of the annual report of a listed entity or even a large unlisted entity also, you'll find a whole comprehensive section on stakeholder engagement and mortality assessment, because that is where you understand what impacts are there which you are required to address, and you are required to amend your business strategies also according to same. Because ultimately the goal of those who are running the entity, or those who are sitting at the top of the entity, is to create long-term sustainable value and to have a constant growth over the years, over short-term, medium-term, and long-term horizon. And that's where we say that stakeholder engagement and mortality assessment, and in short, it is called SEMA. It is very important. It is very important. Why? Because the first first reason why we feel that it is very relevant in present regulatory landscape as well as in present corporate landscape also, is that by doing so, you increase the transparency in your communication in your day in day out affairs with your stakeholders. The focus of regulator is shifting towards principle based reporting. That is fine, but the prime reason of coming out with these changes is predominantly bringing in more transparency in the whole corporate world as per se, because it is something from where the lack of trust, as well as if you are trying to build your brand, both things will start from this first start point only. So if you are there to depict, or you say that I am following the ethical business practices or responsible business practices, or I am a transparent organization, I do what is required and I also do what is not required in terms of communicating with the stakeholders, then having an effective stakeholder engagement is something which is very important. Why it is it will increase transparency? Because as soon as you go out public to external stakeholders and you communicate with them that these are the list of material matters, material issues, impact, risk and opportunities, they'll get a flavor of what is going on in the company. Because otherwise, all of us must have attended investor calls, investor conferences. So we do see, ideally or generally we see that investor is the only stakeholder point, concern number one, and investor con call, AGM or conferences is the only way by which a company can communicate with a stakeholder. So both myths are not, both are myths, they are not correct. There are a lot of other ways, and investor engagement is more broader and is more holistic. Stakeholder engagement is an activity which is which can be periodic, which can be regular also, and which can be need based also. So there will be segregation when you discuss, and we'll discuss some practical examples also of a few of the large listed entities in service and manufacturing sector, that as to how they are engaging with their stakeholder. Point number two, why it is important: improved decision making. So the overall thought process behind keeping up these sessions as well as carrying out an effective SEMA exercise is that you embed the learnings out of the whole engagement exercise into your decision making, because ultimately it is going to help you in taking your financial decision, in taking your non-financial decisions, in taking your reporting decisions also, because you will get to know what is going on ground also, what is hurting, or what is a key concern to your relevant stakeholders, and what can be an opportunity which you might be missing out if you are living in isolation. So it takes us back to our question number third, whether stakeholder engagement is something which is to be done in isolation, or it is an exercise which is to be done with consultation of external stakeholders. And obviously the answer is an affirmative, and the second option is correct, that in stakeholder engagement exercise or materiality assessment exercise is incomplete, is inaccurate until unless we engage at a deeper level with the external stakeholder. Third is about building trust and credibility, and it is somewhat related to the first importance which an effective stakeholder engagement and materiality assessment brings with it. That so if you increase transparency, so if you adopt transparent reporting practices as well as transparent business practices, so the reporting is not only something which we will be discussing today, because it is about an adopting an holistic approach of embedding these things into your strategy. And that's why double materiality has come into play, because the key concept of double materiality assessment before rolling out the outcome is that how you are embedding these material matters into your strategies, value creation process, and future, how they are aligned with your future goals. And then you are required to give the performance also. Because until unless I can write a few lines, few paragraphs, or I can write excellent qualitative disclosure, because but everything has to be quantitatively assessed and quantitatively measured also, that whatever I have promised and whatever I have said is being done, and it is under progress if it is so. So it is very important and it is an integral part of your entity's exercise if you are going for building your brand, if you are if you are trying to create an impression in the market. Because as soon as you will go public with this public, I meant relevant stakeholders, not that you are going to roll out these surveys or engagement exercises with public at large, but as soon as you go, in engagement with your relevant stakeholders, it in itself gives a message that the entity is very transparent in communication as well as reporting. Second, that the entity is being governed in a good corporate governance structure. These are the two basic foundation stones of building your brand and building trust in among your stakeholders, because it is equally important to build that level of trust, level of understanding with your investors as well as other stakeholders, important stakeholders such as value chain partners and regulator stakeholders. Then comes the fourth important, or I would say it is the base of why we conduct an stakeholder engagement also. Because if when you talk about materiality assessment, so these are two wheels of you would say a motorcycle, these are two wheels. So I have one wheel in form of materiality assessment, but if you don't do stakeholder engagement, it will not be able to move anywhere. So if you want to identify relevant material impact, so doing an exercise in isolation, sitting in office, or discussing it with internal stakeholders, as somebody may call it, that see mera malik to ek hai, ya this is what is relevant to internal process owners, then you will not be able to get the flavor of what is actually relevant for you. So if you want to identify actual practical material impacts means sustainability matters. Sustainability matter means environmental, social and governance matters, which might have an impact on your entity's value creation process or vice versa. Because we are talking and we will discuss double materiality, then every impact can be classified or can give birth to a risk or an opportunity. So as we said in beginning, and as said by Anu sir also, that see, it is very important to segregate these two functions. We need to understand if we are working in secretarial teams of any of the listed entity or on auditor side also. Risk management, internal financial control or internal controls are different from material issues. A material issue may be a risk or may be opportunity. So if we want to conduct this exercise effectively and efficiently, then having an effective stakeholder engagement is something which is very important. Then comes some of us might be working in internal audit or internal control department also, risk management. So the ultimate outcome of a SEMA exercise, stakeholder engagement and materiality assessment exercise, is to identify what is relevant for you. Got it? Second is, it might it might give you a different perspective that these are the few kind of risk or few risks which were there and which were not identified earlier in your internal assessment also. So it might give birth to a risk, then it will help you in managing or mitigating those risks at an early stage. Because see, prevention is better than cure, it has been said in common parlance also, and that's what is applicable on risk management also. So if you identify any risk which may be actual and potential, that we also discuss in the latter part of our presentation, that how an impact is to be categorized, whether it is potential or actual. So if it is actual, then you can mitigate it at a very early stage and your entity will be having less repercussion about that. If it is a potential threat to your entity's value creation process, business model, or any type of other broader risk categories, then in that case you can have systems or processes in place so that that risk doesn't occur in future. Or the point number two is that if even if it occurs, then the impact of that occurrence is very limited. Second is innovation. So as we discussed, an impact or a material issue can be a risk and can be opportunity, correct? So if it is an opportunity, so it is giving me a different mindset and different thought process, that how to bank upon that opportunity, how to embed that opportunity in my value creation process and business model. So that these are the two very important or primary facets of a stakeholder engagement and management exercise. Then comes future strategies and goal, and I think it is somewhat related to point number 2, when we discuss that how an effective and efficient stakeholder engagement and management exercise improves your decision making at the top. Because when you follow a top to bottom approach, or when you are sitting to discuss future strategies, forward outlook, or deciding goals for your entity, then probably it is the job of stakeholder relationship committee. So it is mandated by SEBI also, that you need to have a stakeholder relationship committee. Almost every listed entity has that committee. So the outcome of an effective and efficient stakeholder engagement and materiality assessment exercise will be input for curating your future strategies, as into if something is going to take a hit on your business model, hit on your revenues, hit on your profits or your reputation, then how do I cultivate a culture within my entity, or how do I integrate it in my processes or a strategy as a whole, that the impact can be minimized or can be brought down to zero? What goals actually I'm setting for my forward or future looking outlook? Goals can be in terms of financial goals or in terms of ESG goals also. And that's where when we discussed, we said that ESG materiality is something different, and double materiality is something different. We will discuss both materiality assessments so as to compare that which is more holistic and what is more important and what should be done by invested entity or other entities also if they are interested into. So the outcome of an effective stakeholder engagement and materiality assessment exercise will serve as an input for developing future strategies, for developing please continue. So for developing future strategies, for setting out future goals. So we have our Vice Chair, C. Rajesh Sharma ji with us. Over to you, sir.
Definitely, I will not intervene in between. I welcome all the participants who are attending from the whole country. And CMI goes to be one of the most important committee where among the chartered accountants fraternity, I can say now 80 to 90% are going towards industry. So this becomes the most important committee of ICI. And I have been serving this committee since long. So this year also, to some extent, I will serve definitely as a vice chairman, because with a limited responsibility, I will be serving. So that is all. And I welcome each and every one of you. And also I welcome our speaker, Kuldeep Kothari, who is just like a younger brother. Over to Kuldeep Kothari and Mr. Manning for further deliveries. Thank you.
Thank you.
So it's been years of association with Rajesh Bhaiya, I would say, and I was connected with Rajesh Bhaiya from the time I was a student, I think, when you were serving as an NISC
in the year 2011 when he was doing GMCS, his batch number was 307.
Correct, sir. Yeah. So it's been a long association, and it's a privilege to be here to share the screen or share the dice with Rajesh.
Yes, please,
thank you, sir.
Please continue. Yeah. Video.
So I extend my heartfelt gratitude towards the Vice Chair of the committee for sparing time and sharing his words of wisdom. So we were discussing why an stakeholder engagement and materiality assessment is relevant. We were discussing that how an outcome of a effective and efficient stakeholder engagement and materiality assessment will serve as an input for your future strategies and goals. Then comes the point number 8, that's enhanced disclosure. So see, if I'm doing something, it is fine. If I'm following a certain set of processes to conduct my business, it is fine. If I'm adopting transparent reporting practices, then it is fine. If I am having good governance practices, then it is fine. But ultimately, see, it applies to the common life also, that you need to express, you need to tell, you need to communicate that what actually is being done. So until unless I report or I present the outcome of that particular exercise in an lucid and holistic manner, it is not going to serve the purpose, because then again it will be limited to those who have participated in that exercise. There might be a case, see, for example, you take an example of a bank. There will be, if a bank is having 5,000 branches, there will be lakhs of customers, crores of customers. So if you roll out a survey for your customers, then do you think that everyone is going to participate? The answer is no. There will be thousands and lakhs of investors. So whether every shareholder or investor is going to participate, the answer is no. So meaning by which, so if I don't disclose the same in the right manner and spirit, then it is going to be limited to those who have participated as well as within my entity. And that's where, before you make a disclosure, the importance of vetted prioritization is something which is required to be taken care of in mind. So let me give an example. In detail we will discuss later on when the relevant topic comes. I conducted as an entity in mortality assessment exercise, and I'm a finance person. Chartered accountants are predominantly finance person. So I asked somebody from the financial fraternity, that how invest management exercise or how invest management issue is going to have an impact on my entity per se. There might be, there are good chances that the outcome or the answer of the same will not be the one which is actually relevant for the entity. For example, if somebody asks me, I'll say, yeah, waste management, it is related to environment, it is related to ESG, it will be relevant. So I'll take out of 1 to 5, or if the question is on scale, scope, or remediability, etc., I'll give it a substantial weightage. And that entity is an entity. So we need to understand that if it is a manufacturing concern, then there might be a case that waste management is a relevant topic or relevant material impact or concern also. But for a service industry, it is not something which is very much relevant, which can be of high impact and high importance, or which can be of critical importance to an entity. So that is where we always say that there has to be weighted prioritization, and assessment of those survey result are something which is to be done in letter and spirit to figure out what is more relevant. One more example. See, before doing a mortality assessment, you need to do stakeholder engagement. That is what we all have, got to know till now. So when you do stakeholder engagement, it is primary ownership of the internal management to identify, relevant stakeholders. Then it will certainly move to your board of directors or to your KMPs or management committee members, so as to they can give their weightage as to what they feel is more important to the entity. So in this exercise also, there might be a case that a stakeholder, as good as a value chain partner, was, in one case was on the basis of, if you take the sum of plain results, that is, somebody has given 5 out of 5, or on various parameters. I'm saying hypothetically 5 out of 5 in all parameters to an value chain partner, or vis-a-vis somebody has given 4 or 3. So let's assume somebody has given 3. So it was coming out to be in low influence and low impact stakeholder, whereas it is completely different, irrespective of the industry I am working into, irrespective of I am working into manufacturing industry, if I am working into service industry. And stakeholder, as good as value chain partner, will be someone who is of high importance and high impact. And let me tell you where I'm coming from. When you say high influence and high impact, every stakeholder engagement or a stakeholder prioritization is done on the basis of influence versus impact. That is, a matrix is required to be prepared, that as to what influence and stakeholder has on the company itself, vice versa, and what impact the company is having through its value creation process or business model on that particular stakeholder, or vice versa. So an influence versus impact grid is required to be prepared, and based on the same, the stakeholder prioritization should be done. So again, it calls for an weighted prioritization. There might be a case that I'm heading finance, but I don't have interest or don't have specific knowledge about sustainability. There might be a case that I'm heading sustainability and don't have knowledge or interest in internal controls or in maybe cyber security, in maybe AI, etc. So whenever these assessments are to be done, whenever these results are to be assessed, they are to be done in a holistic manner and applying the weighted prioritization. So when we discussed last, importance of an effective and efficient stakeholder engagement and materiality assessment exercise, we said that enhanced disclosures. So there has to be a framework which is driving these disclosures. The answer is yes. So what framework as to a company is following? It is an independent individual choice of an listed entity or unlisted entity. Something which is mandatory, that is BRSR, business responsibility and sustainability reporting, is mandatory on top 1,000 listed entities by market capitalization, and it is effective from it was made effective from 2021. Previously it was BRR, now it is BRSR. So it is something which is mandatory. You cannot skip if you are falling in that particular bracket or particular threshold of top 1,000 listed entities by market cap. Then the other reporting frameworks, there may be an framework which is applicable on an entity if it is operating within a specific geography. For example, CSRD, ESRS. It is CSRD is Corporate Sustainability Reporting Directive, and ESRS stands for European Sustainability Reporting Standards. So it is applicable on the countries which are part of European Union per se. So, but it is the only framework or formalized framework which has prescribed the standards and the methodology for carrying out a double materiality assessment. So it becomes important for the entities who are out of that European Union geography also, that if they are adopting, if they are saying that they are conducting double materiality assessment, then it has to be, in my understanding, CSRD or ESRS. There is no other framework as such which explicitly prescribes double materiality. Those ESRD, ESRS, there is a guidance note also from EFRAG, that is European Financial Reporting Advisory Group. It has given a guidance IG1 and IG2, which states that how these frameworks, that these global frameworks such as IFRS S1 and S2, how these global frameworks such as integrated reporting or maybe GRI also can be interconnected, how they are interconnected with CSRD and ESRS. So framework number 2. Third is integrated reporting. We have discussed integrated reporting in detail in our last webinar also. And those who are not, very familiar with this topic, will discuss what integrated reporting means and what is stakeholder engagement and materiality assessment exercise in integrated reporting. What is SEMA exercise in BRSR? What is SEMA exercise as per CSRD and ESRS? Then we'll come to a conclusion that what is double materiality assessment and does it make any sense also. So if I'm saying something on a platform or if I'm advocating something based on my understanding assessment, it doesn't mean that it is explicitly it may be relevant or I am correct. So we need to intricately we need to assess whether what we are saying is makes sense to the entities or not. Then comes GRI. It is one of the most oldest reporting frameworks, and after introduction of integrated reporting, I think IR has taken over, but still a lot of companies are following GRI. So GRI was predominantly relevant for those who are assessing the impacts in terms of ESG parameters. So as we say in almost all of our deliberations, so one has to be very clear as to what we are benchmarking. On one side, if I'm claiming that I'm preparing an integrated report and I'm writing 10 frameworks that I benchmark this GRI, I benchmark TCFD, I benchmark CDP, I benchmark SASB, CSRD, SRS, it cannot be a case where it is correct. So it has to be a case that I clearly mention that what framework I am benchmarking to. The same applies to BRSR also. So because BRSR is a statutory requirement, and it is mandated by SEBI, so it has to be followed if you are falling within that bracket of top 1,000 listed entities by market cap. So in BRSR also, or in guidance note of BRSR, they don't prescribe any formal methodology or assessment method for carrying out stakeholder engagement as well as materiality assessment. But what we understand, my opinion might be, or my understanding might be different from what you understand. That when you see the point number 26 of section A of BRSR report, that is where they talk about material issues which are relevant in terms of sustainability and responsible business conduct. So it is not related to or limited to ESG. That is something which we need to understand and keep this in our mind. So you see the last column, we will come and discuss about BRSR also in detail. You see the last column of that material issue or matter point number 26. It says that what is the financial implication of a material issue, whether it is positive or negative, and if you want to give descriptive, descriptive reasons for the same, then you are free to give that. So in it gives me in sense that the intent or the idea behind framing such a format was to somewhere take into account both ESG mortality, that is impact mortality, and financial mortality also, because otherwise there is no point in asking the financial implication. So if even if you are doing an ESG mortality assessment, you are saying that I'll do ESG mortality assessment only, it is advisable that you add this financial implication related question into your surveys, into your engagement methodology, whatever way you are having that those surveys, maybe through some of the online channel partners, maybe through town halls, maybe one-on-one interaction, maybe your front-end employees, if it is an entity which is directly dealing with public, in case of banks or in case of insurance companies, etc. Those whosoever are dealing with your customers or your value chain partners may take this into account. Then integrated reporting, BRSR, CSRD, ESRS. Why I say that these three things are interconnected? Because somewhere the intent of BRSR is also to carry out a double mortality assessment. Integrated reporting is now governed by IFRS Foundation. So IFRS Foundation is the governing body which has rolled out the sustainability reporting standards S1 and S2, and that is to create a global baseline. So because when you talk about IFRS, India's are reporting standards which have been carved out of from IFRS, that is within primary reason to have an comparable set of financial statement throughout the globe or throughout the countries which which have adopted IFRS. So the same thing is needed or is required in sustainability also. So that's why, or with that thought process only, the IFRS Foundation has come out with IFRS S1 and S2. And IFRS S1, when you will read that particular standard in detail, it talks about two important things. It talks about stakeholder engagement and maintaining a dual relationship with your stakeholder. That is nothing but it is related to double mortality. And it says that there has to be interconnectedness and interlinkage of information between your financial data and non-financial information. So integrated reporting is also governed by IFRS Foundation. So that's why it makes more sense if we integrate these three reporting standards, because ultimately the purpose of every communication or every report is to have an transparent communication or transparent reporting disclosure with for your users of financial statement. So no duplicity of data should be done, and these framework also provides for interoperability of various reporting frameworks. More importantly, BRSR, because it is something which is in statutory requirement. Somebody might say that, see, if I am doing something in BRSR, I cannot cross-reference it to other sections of my annual report. If I am doing something in MD, I can't cross-reference it to my integrated report. The answer is no. The guidance note of regulator itself says that wherever you have given relevant information related to those issues or those questions which have been asked in BRSR in other sections of your annual report, it can be cross-referenced. So the pain point might be that BRSR is something which is required to be filed online also in XBRL format. So it may be a pain point that if you generally people tend to see the report and file it in the XBRL format. So it might be a case that at that time you need to do some to and from and navigation within your report itself. So that's why it makes sense to have these three frameworks, adopt these three frameworks in integration. So if somebody says that I have adopted double mortality, then it cannot be without adhering to either integrated reporting or ESRS or CSRD. Do we have any questions till now? If we have, we can take up these questions. Otherwise, we can take it in the end also. We can take it.
Yes, sir. Please continue.
So integrated reporting, I will not take much time on integrated reporting because it has been discussed in detail in the last session also. But those who are attending, those who are new to this particular topic, integrated report or integrated reporting, it was incepted in 2013. So it was previously governed by IIRC, Integrated International Integrated Reporting Council. Then in 2017, 19, I would say, it got merged into Value Reporting Foundation. And then Value Reporting Foundation was taken over by IFRS, and now it is directly subsumed under, and it is under the ownership of IFRS Foundation. So integrated reporting is an holistic reporting framework which gives a different perspective as to how your entity is willing to communicate and disclose your financial as well as non-financial information. It is not about putting up different piece of puzzles into a place and show that it is an one all picture. It is about putting up the systems in place. It is about integrated thinking. It is about stitching the thread in such a way that all things looks interconnected. Otherwise there is no point in doing an integrated report for the purpose of doing, because what we discuss and what we feel is that the intent is not about pressurizing for compliance. The intent is not to talk much about clerical works and compliance. The intent is to develop strategic thinking. That's where we can elevate ourselves to the top of our organization where we are working. So integrated reporting or integrated reporting framework, as we say, it has seven guiding principles and 8 core elements. It has 7 guiding principles and 8 core elements. And again, I say, if you might see in India also, in top 200 or top 100, more than 50% of the entities are doing integrated reporting. So if you write that you are preparing an integrated annual report, then let's not do mix and match, and let's not create a mixed salad out of it. So let's keep it simple. If you are benchmarking something with GRI, then let's not say that it is benchmarked with GRI as well as IR also, because an integrated report has to be prepared in line with what integrated reporting framework prescribes. So 7 guiding principles are on your screen. First is strategic focus and future orientation. Second is connectivity of information. And why I say that integrated reporting it makes more sense and more relevant, because when you see IFRS S1, which is the global baseline for sustainability reporting also, it also talks about interconnectedness of information, connectivity of information between financial and non-financial data. Third guiding principle is stakeholder relationship. Stakeholder relationship, from this background we are coming from, and why we are discussing integrated reporting in a session which is dedicated to stakeholder engagement and materiality assessment. The fourth guiding principle is materiality. Fifth is reliability and completeness, that is a common principle. Consistency and comparability. So as said by our chairman sir also in the beginning, so the time has come that reporting is not limited to, or communication is not limited to doing something maybe out of the box also, but it has to be consistent and comparable throughout the years. And that's where we were discussing yesterday only with a large listed entity on what KPIs are required to be disclosed. So it is very important. So this KPI thing, key performance indicators, it plays a pivotal role in disclosing your value creation model. It plays a pivotal role when you disclose your stakeholder engagement exercise also, and you disclose your materiality assessment also. Because if you are adopting a double materiality assessment, you need to show the performance. You need to show that how well you have done in terms of the goals, targets, strategies that you were required to make for a particular material impact or risk and opportunity. If you are disclosing that stakeholder engagement exercise, then it requires you to ask that what value you have created for your stakeholders. So eventually, if I give a lot of quantitative qualitative data, it will not make sense. There has to be something which is identifiable. There has to be something which directly strikes in the mind of the user also, that yes, it has made sense. So last guiding principle is that IIRC or IR framework, as we call it now, it has only one methodology which is there, that is 6 capital reporting. We'll discuss what 6 capitals are. So 6 capitals are human capital, manufactured capital, natural capital, social relationship capital, intellectual capital, and your natural capital. So these are the 6 capitals which are required to be taken care of. Out of these 6 capitals, you will see that your natural capital, your social relationship capital, it includes social part as well as your relationship. So it will extend to your value chain partner, your distributors, your agents, etc. also. And then the third is natural capital. So these three things are related to ESG factors. Uh, and then there is manufactured capital, intellectual capital, and human capital. These are something which is related to a different holistic point of view. So what are the major components of an integrated report? First, value creation process. So the basic idea or concept of an integrated report or integrated reporting, in terms of adopting or integrating it with your business model also, what value you have created, what value you have preserved or eroded throughout the reporting period, and in short term, medium term, long term horizon for your stakeholders. What material issues it is impacting. Then ESG factors. Obviously, it includes ESG factors also, and that's why we call that an ESG assessment or an integrated report or sustainability report cannot be compared, because it is more holistic and it is a broader perspective of looking at reporting. Then 6 capitals. As we say, 6 capitals are the baseline of any integrated report, and there is no other way through which you can prepare an integrated report. Materiality assessment and stakeholder engagement are two important wheels of this whole exercise. So, if you do an effective stakeholder engagement, materiality assessment, then you will be able to present your value creation model in the right way. And as we discussed, the base of integrated reporting is not preparing, not putting up various different puzzles in place and show that it as an one picture, but it is stitching the whole process and every department and every narrative in such a way that it looks that everything is interconnected and story is flowing. So it that's why the concept of thematic annual reports or integrated reports have come into play, because they give a better picture in terms of what your entity is trying to communicate with the stakeholders. What is required to be shown, why we say that it is integrated thinking. So the base of integrated reporting is value creation process. The base of integrated reporting is disclosing all these 6 capitals, how these capitals are introduced. Then it is not limited to giving your value creation model, but it is very important that how you are showing the trade-off between 2 capitals. For example, I am talking about an intellectual capital. And company is investing into AI, say, is investing into various new technologies per se. Or you take an example of a media entity. A media company has prepared some virtual sets. We all see news channels or other entertainment channels also. So we see some panelists are sitting on Parliament House, or some are sitting somewhere in India Gate, etc. Or Nariman Point in Mumbai, or somewhere else, Charminar in Hyderabad. So these are virtual sets. So these are intellectual properties. So how an intellectual property exercise or how intellectual property KPI is going to have an impact on my financial capital. So if I invest into technology, one is going to be outflow. That is my input to intellectual capital. What is the outcome? It may be that how many virtual sets I've created. But the cost that it has saved me throughout this whole process. Otherwise, I would have been required to travel to that place to make some logistic arrangements to set up this physical set at each and every instance. So it has to be a case where I am able to depict that critical interdependency between various capitals, how these capitals or how these functions are interlinked, intervened, and they are trading off between each another. So it is very important that in terms of creating long-term sustainable value, it is important and imperative for the organization, as we discussed in detail in the beginning also, that to understand what is the legitimate needs of a stakeholder, and that is only possible, or a tailor-made solution is only possible, or an actual assessment is only possible if I am interacting with internal as well as external stakeholders, and a correct universe of material matters is being pushed to these stakeholders, because ultimately, see, I am not coming from a background where I say that you simply type and survey or give a questionnaire to your stakeholders and you ask them that what are the relevant material issues for us. That is not the case. You need to figure out the material matters or material IR universe within your entity. Then you need to push it out to your stakeholders, maybe all topics to all stakeholders, maybe all IROs to all stakeholders, or maybe relevant IROs to relevant stakeholders. There can be an quantitative or qualitative question which you can ask to your stakeholder in your part 2 of your exercise, that in addition to these topics, if you feel if there is anything which is relevant, and if a large number of people, large number of stakeholders says that yes, it is relevant, then you can take that into consideration. So this, I think we can skip. We have already discussed 6 capital approach. So this is a sample stakeholder engagement of an integrated report. Why it is more important to to understand that how a stakeholder engagement is being done in an integrated report, because we often see that usually there is a sync between what is being disclosed in integrated reporting section or a GRI annual report section, what is there in BRSR, but in many cases people do confuse it with an ESG assessment. So something which is there in your screen, on your screen, is a stakeholder engagement exercise of a very large FMCG conglomerate. It pertains to last year because the current year's data is not yet out. It will be out with the annual report only. So they've identified 6 stakeholder groups. So when we talk about stakeholders, we need to identify broader stakeholder groups per se. Why we see stakeholder groups? For example, a consumer for a bank can be a retail customer, can be an institutional customer, can be a corporate customer, can be an DSA also. So I cannot, disclose, or I should not disclose all 4. Otherwise, so it will be 6 multiplied by 5 or 6 multiplied by 4, and I'll be disclosing 24, 30, or 40 odd, stakeholder in entity. So we need to identify broader stakeholder groups as into what is more relevant to the entity. We need to identify these subgroups also, and then in an internal exercise based on the assessment which we have done internally with our managing committee or KMPs or etc., we need to figure out that what broader stakeholder groups they are related to. Then on the left you see that they have shown also that how they are interacting with their stakeholders. For an example, in case of an consumer, they say that what is the key concern, or what matters to them most, why it matters. Accessible, reliable products. Obviously, if it is an FMCG company, there will be an aspiration, or there will be an understanding from every consumer that whatever he is getting is of a superior quality. Then right price is also something which is important. Sustainable operations. It should not be that more plastic is used, or whatever process the company is adopting in manufacturing that product is not harmful for the environment per se. Then the second facet of this engagement exercise is engagement, but how you are engaging with your stakeholders and what is the frequency. So there can be a case that I'm conducting customer surveys. It can be one-on-one exercise also through external channels. It can be even an interaction exercise which is carried out throughout the year through my sales points or through my distributors, etc. It can be an year-end survey which I roll out to relevant stakeholders. And the engagement can be periodic, can be need-based, and can be on daily basis also. That's why they've written ongoing basis. So this is an example of a stakeholder engagement, how it looks. It is the final outcome. It is not the input. It is the outcome of what we have discussed, that we need to prepare a universe of stakeholders, relevant stakeholders to the entity based on the peer benchmarking, based on the industry practices, based on the business model. Because ultimately what matters is you need to understand the context of business. You need to understand in what context you are conducting that exercise, and in that context only, in that relevance only, you are required to figure out what is relevant to the company, why it matters. That is what we are discussing now. Now, the second example, which is there on your screen, is related to materiality assessment. This is the materiality matrix which this same company has depicted in its sustainability report. It is not double materiality because they themselves have written that it is an ESG materiality matrix. ESG materiality matrix is something, or ESG materiality assessment is something which is a little bit narrower in approach because it focuses on three parameters only: environmental, social, and governance factors. So you see on your screen that they've classified these material issues. So ideally, what happens is that you prepare an universe of material issues. If you are doing even single materiality, then you push it to your stakeholders, and based on the responses that you receive from your stakeholders, you prioritize those material metrics and you put the same on this type of grid, because x axis and y axis can be and will be the same. It is the way of presentation which we can change, otherwise the graph will remain to be the same, the presentation in the format will remain to be same. So in this ESG materiality matrix, they have classified these material matters into moderate, important, and very high. So when you talk about integrating it with BRSR, as they might have done it, I'm not sure. BRSR says that only the matters which are critical to your entity are required to be disclosed. So it doesn't mean that I don't assess those matters which I feel are not critical. So there may be a case that I've started this exercise by taking like 15, 16, or 20 matters, and out of these 15, 16, or 20 matters, only 8 comes out to be critical one which are required to be taken care of by my company. So that's what have been done by this entity also. You see approximately 20 or 21 odd topics on this materiality metrics, but they've taken out 7, 8 topics only which they felt that are more relevant. That is, they are high on prioritization in terms of impact on business and in terms of impact on stakeholders also. So on the left hand side, you see that they have shown that how they are engaging in relation to each and every topic. So they've given description, but they've given priority also. But what is missing there? It is missing that how it is embedded in your strategic initiatives or value creation process. What is missing? How your entity is responding to this material issue? What is missing? What is your performance in terms of this material issue if you have set up any goals? So this is not an correct way to have an materiality assessment if you are presenting an integrated annual report. And why we discuss this in detail, you might see a different picture this year maybe, but may not be. But since this entity is preparing an integrated annual report, it has to be in double mortality assessed mortality matrix which is required to be disclosed. So this is an example of a large manufacturing entity which has shown in a very good graphical manner how they have conducted their stakeholder engagement exercise. They have also identified 7 stakeholder groups. See, I understand, and we understand as an industry also, there may be a case that somewhat at some level number of stakeholders may be limited, but what prevalent practice is going on these exercises is control C and control V. So we need to eradicate this practice of control C and control V, because what is relevant for me as an for example as an FMCG company, what is relevant for me as an service industry may not be relevant for a company which is a manufacturing entity but not in the same sector. So it has to be very specific, and that's why we say again emphasize on the weighted prioritization. So they have taken out 7 relevant stakeholders: customers, vendors, communities, influencers, employees, investors, and government and regulators. Then they've given the purpose of stakeholder engagement also, and how they've carried out this exercise. Again, I would say that this is not the process, this is the outcome of the whole process which you have followed. It is more important how effectively I'm able to depict what I have done on ground, because there may be a case that I'm doing a lot more than what I'm able to disclose effectively through my reporting means. That is, annual report is the only place where I can play with this, or a sustainability report. If I'm publishing a separate sustainability report, or a separate integrated report, or a separate report on SEMA itself, these are the only means through which I can depict what I have done throughout the year: planning, identifying, engaging, reviewing, and improving. So these are the 4 steps. we have already discussed these steps, in detail in the beginning. So then on the right hand side, you will see for customers, in last example, you have seen that they've written what are the key concerns. In this particular example, they have written how we engage with them directly. They've given a description as we are required to give for a material issue. Then they've written key imperatives also. So key imperative is something which is key concern, or it is something which actually matters to these stakeholders. And then frequency of engagement is ongoing. Again, what is missing? Why it matters? Maybe it is there. What is more concernful for them? It is there. How the entity is responding? It is not there. What is the performance or what value your entity has created throughout the year for these stakeholders? It is missing. Then it is an example of materiality assessment of the one of the largest company of India. So again, it cannot be said to be an double materiality assessment, because again it talks more about material ESG material matters, but yet it is a better approach to disclose the same outcome. Then this can be said to be an maybe near to apt example of an stakeholder engagement in a double materiality assessment in an integrated report, how it should look like. So the processes remains to be the same. The only thing which will change is the way you perceive these issues, perceive these communication channels, and how you respond to this. So if you see on the right hand side, in customers, they have given channel of communication, that how you are engaging with your stakeholder, that is customer, what type of engagement is being done. It is very important. So it may be a case that it is one way communication, it may be a case that it is two way communication. For in case of a customer, it can be a two way communication, that is information and consultation also, for understanding the real practical issues related to your stakeholder. Then key concerns and expectation. There may be a case that it is an your stakeholder is concerned, or is worried, or has some sort of reservations in relation to something which is impacting them coming out of your business model, or it can be an expectation in terms of what they want you to achieve as an entity. So key concerns and expectations are there. Then aptly they have shown the response and mitigation, because my job is not limited to disclose and depict. Maybe even if I'm doing it on the ground, it is not limited to disclosing channels of communication, type, frequency, key concern, but how I am responding to this. Because ultimately this is what, as a stakeholder, a layman, I'm going to read and understand that how your entity is responding to these material issues, stakeholders. Then value delivered. Again, in this value delivered, that is the, you can call it shared value creation, you can call it value created throughout the year, you can call it the performance in terms of each and every stakeholder. So it can include qualitative as well as quantitative information, but I think it should be a case that more quantitative KPIs are required to be depicted in this particular section of stakeholder engagement materiality assessment. Again, on your screen can be said to be a near to okay example of a double materiality assessment, where they have shown the materiality assessment process, in which they have shown that first, identification of material topics, it is to be done in house only. Your entity, or you are the owner of your material issues, but you need to prepare a relevant universe of material issues or topics which are to be pushed to your stakeholder. Then you need to carry out stakeholder engagement and assessment surveys, etc., consultation with your stakeholders. And then based on those responses, weighted prioritization is required to be done. As said in the beginning also, there might be a case that I am answering any question related to sustainability or related to internal control. So vice versa, the response may not be correct, or may not, or should not have the same weightage as it is to somebody who's from the sustainability background answering the question, relevant question. Then evaluation of these potential, actual, positive and negative material impacts, or IROs, as I would like to call them. Then if it is a risk, then it is required to be embedded in your risk management framework. As I said in the beginning also, it is very important for all of us to understand that ERM, risk management, internal controls, internal audit, RMC, these are primarily different from a material IRO. A material IRO in itself means that the impact may give birth to a risk or opportunity. But if it is a risk, then ideally it should move to your RMC or to the process owners and then to RMC and then eventually to the board to be, if they consider it to be relevant to be included in your ERM framework. Then a final materiality sign-off is required. On the right-hand side, you see that they have shown the management of material topics. The material topic in this instance is related to sustainable and responsible financing, which is very relevant and which is very important in present context also for a bank. So they've given a description of what this relevant topic means for them and why they've thought that it is important. So you can call it why it is important. They've given it. Then description of impact, that what impact it has on your entity. So when you do a double materiality assessment, the first exercise to assess an IRO is to assess whether it is a potential, whether it is having a actual impact or a potential impact. Then if it is a potential or actual impact, then whether it is having a positive impact or negative impact, and if whether it is a risk or opportunity. A negative impact can only happen if it is a risk. In opportunities case, it cannot be a negative impact. So based on this, your survey questionnaire or your assessment methodology will change. Then they have shown the performance also, and they've shown two KPIs in terms of sustainable financing, that out of the total wholesale loans that they approved throughout the year, 26% pertains to the number of loans that they have sanctioned for the companies or for the entities which are following ESG risk management practices or framework, etc. Then they have given the number of the total amount which they've raised to sustainability bonds. But again, what is missing? How this material impact or IRO is embedded in their strategy, their strategic initiative, how it is impacting their value creation process. So what they have done right, why it matters, description, whether it is a positive, potential, negative, actual, opportunity, or risk, all fine. Then what is the performance? It is fine. But how it is embedded into my strategic initiatives and value creation process, it is missing. It is an integral part or integral requirement of a double materiality assessment. Then, this is a materiality matrix again from a bank, which they call that it is an double materiality matrix, which I feel that it is, my opinion, it is not a double materiality matrix. Then it is a materiality matrix of a large listed entity, which you can call indeed the most apt materiality matrix to my understanding, which I've seen. It shows the financial materiality, impact materiality, and then it has given a color coding to all these material issues. And as I said in the beginning also, if you talk about BRSR, if you talk about integrated reporting or other reporting frameworks also, it is very important. It is only required to discuss in detail about those material topics which are more relevant, which are having high impact and high influence here in terms of both materialities, both perspective, in terms of impact perspective, in terms of financial perspective also. And quickly we'll discuss about BRSR in next 5 minutes, and then we'll come to double materiality assessment as per ESRS framework. So BRSR was introduced or maybe incepted not in the current format, but in some other format, other manner, when the Ministry of Corporate Affairs came out with a National Voluntary Guidelines on Responsible Business Conduct, NGRBC as we call it. Then in 2012, BRR was introduced. In 2017, SEBI came up with a voluntary reporting framework, integrated reporting, which we discussed in detail also. And on this topic itself, we had a very fiery discussion with one of the secretarial team of a listed entity, where they said that this is the SEBI has issued only one circular, which was issued in February 2017. And it says that you cannot cross-refer anything to any other section of your annual report. At that time, BRSR was not in existence. So they're given reference to BRR as well as MD&A. But what came out to be true is that SEBI has said at that time also in recent guidance note on BRSR or as well, they've clearly mentioned in the interoperability of various reporting frameworks, that if any other information which is required to be given in BRSR or vice versa in other reporting frameworks, if it is given somewhere in the annual report, let's reference the same to the relevant question. Cross referencing is important because otherwise I will not be able to make it out from 4, 5 or 600 pages of your annual report. But in no case duplicity of data is required. Then in 2020, when BRSR was introduced, 2023 calls to be the landmark year in terms of development in BRSR. When BRSR core was introduced, then 2024, SEBI came out with some sort of reporting disclosure for value chain partners, assurance assessment. Then again, in lieu of ease of doing business, the same was deferred, and same is deferred to next year. It is not abolished or it is not taken back for eternity. It is only deferred for a year or so. So this is the journey how BRSR has evolved throughout the years. We'll not discuss in detail what is BRSR because we have had a separate session on the same. BRSR, primarily it is divided into 5 parts. It has some questions which gives you a sense of freedom to write whatever you want to write. That is free flowing text. It has some tabular questions also, like in case of material matters. It has some complex calculation, though those complex calculations are predominantly limited to principle 6, in which energy, water or waste related calculations are required to be made. It has emissions which are required to be disclosed as a leadership indicator. It has policy related disclosures which are required to be made. That is section B of BRSR. Then BRSR core framework, it is nothing but it is a subset of 9 core ESG principles. Then new BRSR reporting framework is applicable to top 1,000 listed entities by market cap. ESG value chain disclosures are required to make for 75% of the value chain partners by sales or purchases. It is an individual capping is done at 2%. This is also deferred to next year. It is not in application. And then ESG disclosure related to value chain partners and their assessment or assurance is also deferred to next year. So we are yet to see in an evolving regulatory landscape that how reporting of BRSR or how reporting of sustainability matters will eventually come out in the final manner. So why we are discussing BRSR? Because the topic which we are discussing today, stakeholder engagement and materiality assessment, is covered in 2 sections. One is section A, that is point number 25 and 26. Point number 26 talks about what grievances your stakeholders have. So in order to write down the grievance redressal mechanism system, eventually you need to identify that who all are your stakeholders. Then stakeholder identification, prioritization, engagement becomes an important exercise. Then point number 26, which is the most important part of section A, which talks about entities' material responsible business conduct issues. And again, I'm reiterating and emphasizing on this that please don't confuse it with the term ESG. It is not ESG business issues. It is not ESG issues. It is a holistic approach which the regulator is requiring us to identify, requiring us to assess, requiring us to disclose. You read these columns and you will understand in yourself that whether it is an ESG assessment which is required to be made. Material issue, fine. Somebody might say that it is ESG or business issues. Whether it is a risk or opportunity, it is also fine. Rationale for identifying, that is description or why it matters, which we discuss in integrated reporting, it is similar to that. Then in case of if it is a risk, then how you are mitigating, how you are approaching to that risk. And then the last column, financial implication of the risk and opportunities. You can indicate or you can write simply positive and negative, and if you want to give descriptive reasons, you can give the same. So if you consider the last column as well as the other columns together and you see it from a holistic picture, it gives in sense that it is the double materiality which the regulator wants us to undertake, but it is not prescribed anywhere. So these are the 2 columns where stakeholder engagement and materiality assessment exercise is required to be done. Why we discuss integrated reporting in beginning? Because we are getting a lot of queries in this regard that if I am doing a materiality assessment for BRSR, whether it can be applied to IR. Ideally, both have to be different. if you see it from the naked eyes. But if you are doing a double materiality assessment for integrated reporting or for GRI reporting per se, you do it for GRI also, or for any other reporting framework. Then in that case, if it is a double materiality assessment, the same can be used in BRSR, because BRSR is not limited to ESG material topics. It is there in the guidance note also. Then you come to principle 4, that is section part of section C, where they say that businesses should respect the interests and to be responsible to all stakeholders. So the process for identifying key stakeholder groups is required to be given as an essential indicator. Friends, it is an essential indicator, means comply or explain. So no XYZ process is allowed here. If you do it hypothetically, then it is not allowed, or it is not recommended. If you do it in isolation, then it is not recommended. So there has to be a proper process in place, system in place, where you identify the stakeholder universe, then you prioritize the same weighted prioritization, and then you push it for engagement exercise. Then it give in the second column, it requires you to specifically say that what stakeholder is relevant to which stakeholder group, whether it is related to any marginalized group or vulnerable group. Channel of communications, they have given some suggestive channel of communication. It is not an exhaustive list, but if you write in your engagement exercise that you are engaging with your customer in survey, then there has to be some documentary evidence, because BRSR is something which till previous year was required to have a reasonable assurance, and now from this year onwards it is required to have a limited assessment. Then frequency of engagement and process and scope of engagement is also required to be disclosed. Then the second portion of this principle 4 is leadership indicator. Leadership indicator 1, if you read it clearly, it says that provide the processes for consultation between the stakeholders and the board of economic, environment and social governance topics. So here it talks about the ESG topics. So if someone says that my BRSR materiality assessment or stakeholder engagement is limited to ESG, then it is incorrect in itself. It is there in the format that it specifically requires you to disclose, even though it is a leadership indicator, which if you want to skip, you can skip, but it is required that you disclose that how you are engaging or how you are consulting your stakeholders for ESG related topics. So these are the two places where stakeholder engagement and materiality assessment comes into play. Then this is the snippet of a guidance note which has been issued as a part of master circular of SEBI LODR on November 11, 2024. It says that what all is required to be considered when you assess your material issues. Point number 1, sustainability as per NGRBC principles. Point number 2, it says that the entity shall disclose the material responsible business conduct and sustainability issues. So it includes both. And even if you say that I am assessing ESG, I think almost all my issues will fall under the governance part. So my business issues as well as sustainability issues are required, and it has been clarified by the regulator also. Then this is the snippet of the guidance note which has been issued, the same guidance note for principle 4 disclosure which is required to be made. Then some practical examples of BRSR reports of various listed entities is there on your screen. See this entity, which is a manufacturing entity, says that greenhouse gas emissions and climate change management, because they are into an industry which generates a lot of emissions, direct and indirect emissions. A lot of water conservation, water consumption is also there because they are steel and all. And a lot of polluting factors also emits from the manufacturing process. They have identified this as a material issue. They have given the rationale. Okay, they have given the approach to adapt and mitigate this particular issue. They've given this whether it is a financial, what is the financial implication. So all in all, the thumb rule is that what is the intent of the regulator should be adhered to. Point number 2, to the extent possible, you should not dilute with the format of framework. Point number 3, that this assessment should not be limited to your ESG issues. So again, I'll show you some more examples. This is of a large listed conglomerate. where it has shown in a different manner, a little bit descriptive manner. And if you see the last column related to financial implication of a risk and opportunity, they've given a qualitative as well as quantitative disclosure related to a material issue. Then this is again pertaining to a bank which claims it to be an double materiality assessment. So in BRSR, they've given like more than 7 or 8 stakeholder groups which have been identified, material issues which have been identified. Then they've classified and they've cross-referred it to some other section of the annual report. So this myth is over that you cannot cross-reference. The answer is no, you can cross-reference. It is perfectly fine unless it is not giving an incorrect picture of what it should be. So then principle 4, in principle 4 also they've referred it to the stakeholder engagement and materiality assessment exercise they have carried out for integrated reporting. So what I said in the beginning also, so ideally it used to be a case that the material issues of the process will be slightly different if you do it from a global reporting framework IR or if you do it from BRSR perspective. But practically it should be same to avoid duplicity of data, to avoid unnecessary, misunderstanding or confusion in the mind of stakeholders or the users of initial statement. So this is an again an example of how you disclose. So innovation and creativity can be done in BRSR also until unless it doesn't dilutes with the inherent requirement of the reporting framework. Then again, it is an example of a listed entity which has disclosed in a different manner their material issues or material topics and how they have given details also how they are engaging with each and every stakeholder group and what material issues are relevant for them. So we'll straightforward discuss this double mortality as per ESRS in next 5 to 7 minutes, and they'll take if we have some questions related to today's topic. So what is CSRD? We discussed in the beginning also. CSRD is Corporate Sustainability Reporting Directive. ESR is European Sustainability Reporting Standards. Why it was required? Why it is relevant to entities, and why even we are discussing sitting in India about a CSRD or a ESRS framework, which is predominantly which is related to European countries. So see, CSRD efficiently or what effectively it does, it replaces the old sustainability framework which was applicable on European countries. So if your entity, which because world is a global village, every Indian entity might have or there are chances that maximum of them will have businesses or subsidiaries or entities or associations in these countries, European countries maybe. So in that case, indirectly it is related to you. If you are exporting something, then also it is related to you because your value chain partner is there in that particular country. That value chain partner, this particular reporting mandate is applicable. And third, the main objective which we feel is that it is the only comprehensive reporting framework which prescribes how a double mortality assessment is required to be done and how it should be done. So that's why I feel personally that in terms of increasing transparency, building more trust, reliability, credentials, credibility, and governance, we can benchmark CSRD or ESRS for double mortality assessment. So CSRD is a directive. ESRS is in cross-cutting standards. It is segregated into 3 parts. S and G. So E1 to E5 is related to climate pollution, water, biodiversity, resources use. S, these standards are related to social issues, employees, workforce, value chain partners, and governance is related to business conduct. So primarily ESG is being covered in this ESRS, but the base of a ESRS framework or any E1, G1 or S1 is double mortality. Double mortality is the basis of the whole framework. So it is, if you dissect it in layman's language, it is inside out and outside in. What is inside out? It is impact perspective. That is how your company is having an impact on planet, how your company is having impact on people, how your company is having impact on external stakeholders through or in process of its value creation mechanism or through its business model. Then comes the second materiality perspective, which is financial materiality, that is outside in. Outside in means that in return, how your business operations, how your financial performance, how your company's cash flows, how your company's access to finance. For example, if I'm doing very bad in terms of sustainability, I might be restrained to I might be restrained to some funds which are available at a higher cost, or I'm not I will not have access to providers of conscious capital. So outside in means that how these various material IROs, how these stakeholders are having an financial impact on your entity's value creation process. So inside out and outside in, and the combination of these two. So there may be a case that a matter is relevant in terms of financial materiality and a matter is relevant in terms of impact materiality. So it will be disclosed on two different axes, but it is not double material for your entity. So everything or anything which is double material has to be taken as a critical material IRO, which is required to be disclosed. So when you talk about identifying sustainability matters or material IROs, then you need to assess the universe of IROs. IROs means impact, risk, and opportunities. Then you need to, club, or you need to link it, or you need to sync it with the broader material topics, because it might be a case that if I'm dissecting various materiality matters into material IROs, it may run up to 50, 60, or 70 also, but it has to be clubbed into relevant material issues universe. Then internally, based on the assessment, a threshold is required to be set in terms of impact materiality. So where you assess a material topic for scale, scope, and irremediability. Irremediability only if it is having a negative impact. And then then it moves to the financial materiality part. After engaging with the stakeholders, it moves to the financial materiality path, on which you assess a material topic or material impact on the likelihood of its occurrence and the magnitude of its impact which it might have on your entity, or it is having in your entity. Then the value creation process or time horizon, because the ultimate idea is to integrate all these reporting processes, and while integrating these reporting frameworks or processes, you need to make sure that it rightly assesses that if any IRO is important, if it is an impact, risk, or opportunity, whatever it is, what impact it is going to have in the short term horizon. For example, I have created some I have done some intellectual property related expenditure or some technology related expenditure, and I have expensed it off in P&L. It is not capitalized, but it has given me short term benefit throughout that reporting period. So it has created or generated value in the short term horizon. Then there may be a case something is relevant in a medium term horizon, that is 3 to 5, and then it is a long term horizon, that is more than 5 years. It might have an impact, or it is having an impact, or the impact will occur or will be visible in the coming time frame. So this is how you define the scope of a double materiality assessment. So if anything is relevant from both financial materiality and impact materiality, then in that case, it is required to be considered as a critical material IRO. Otherwise, if it is lying on the financial materiality axis, or if it is lying on the impact materiality axis, it is not. It is up to the organization to make a choice whether they want to disclose the same or not. But it will not be considered as a double material matter. So I think we are running short of time. So if there are any questions, we can take up questions, or otherwise I will continue for next 2-3 minutes and we can sign it off.
Yes, we can.
Do you have?
No, as of now.
No question. So why this particular implementation guidance is important? Leveraging the ISSP standards, or ISSP standards translate into leveraging the IFRS S1 and S2 standard. These are the standards, sustainability standards, which have been rolled out by IFRS Foundation. Because if you are preparing an integrated annual report, if you are preparing an annual report based on the IR framework, then in that case, it is aligned to IFRS Foundation and S1 is also aligned. So in that case, if you want to do a double materiality assessment, it will not be a violation of IFRS S1 because they have given a specific example and context as to how when a double materiality assessment as per CSRD or ESRS is equivalent to what is being perceived in IFRS S1. So this used to be the traditional same approach. I quickly wrap it up. Stakeholder mapping, methods of engagement, materiality assessment, and feedback loops, because it remains to be the same. The only thing which will change that the kind of material IROs which we push to stakeholders, the dual lens of materiality, that is whether we are willing to assess or willing to take a feedback on both perspective in terms of impact and in terms of financial materiality also. Why SEMA reassessment is required? Because the stakeholder landscape has evolved, comprehensive materiality assessment is something which is required to be done in order to move beyond an ESG focused materiality assessment exercise and to have a better transparent reporting practices as well as effective communication with your stakeholders. Then what should be the ideal approach if you're following the double materiality assessment? Then first you need to identify who are your key stakeholders. Stakeholder mapping, as we call it, stakeholder universe is required to be prepared within your entity internally. Then your internal board or management committee members are required to give their responses on that stakeholder prioritization survey. Then based on that, weighted prioritization of a stakeholder should be done to figure out what is who all are more relevant to your entity. Step number 2 is identifying and mapping of key stakeholders, and then it comes to identifying IROs. IROs means impact. It can be a sustainability matter. Impact can be classified into risk and opportunity. So from an impact, a risk and opportunity will arise. So impact can give birth to both risk and opportunity. So a comprehensive peer benchmarking as well as industry study. For example, what is relevant for a banking company will not be relevant for a manufacturing concern. What is relevant for a manufacturing concern will not be relevant for a service industry per se. So what is relevant for TCS may not be relevant for Tata Steel, and what is relevant for a Unilever may not be relevant for any other service industry. So a comprehensive materiality IRO universe is required to be made. Then it is required to be pushed to stakeholders for engagement, where you need to assess it on impact materiality as well as financial materiality. Impact materiality, scale, scope, and irremediability, that is irreversibility of the irreversibility means, for example, if it is having a negative impact, then if that impact occurs, whether it is reversible or if it is reversible, then what time it will take or what efforts it will take to reverse the same. Then in case of financial materiality, you need to assess the impact material IROs on financial materiality in terms of magnitude, that is what kind of or what level of financial impact they are likely to have if they occur, and then the likelihood of occurrence is something which is required to be assessed. In last, a weighted prioritization, as I again reiterating the same word because it is very important to have weighted prioritization to consolidate the impact and financial materiality outcome. And then you need to disclose these two matrices. One is stakeholder prioritization matrix, that is impact versus influence grid, and second is double materiality matrix, which ideally should be a case that you are disclosing only critical material matters or double material matters, but or some companies are doing it on low and high parameters also. But I would suggest, in my personal opinion, if you can segregate into low, medium, high, or maybe moderate, medium, high, or severe kind of impact, then it will be more relevant for the stakeholders to understand holistically that some material issues having high impact but low financial materiality impact, or vice versa, some material issues having high financial materiality impact but a low or medium impact materiality impact. So with these words, I will put my deliberation to end today. Just 1 minute or so I will take to only 1 minute to figure out why it is more important, because see, BRSR is something, again I am reiterating, it is a statutory requirement. So we need to understand because it is a talking point of the whole industry and pain point of the industry also. There is a lot of duplicity of data. Companies are disclosing something in BRSR, something in integrated reporting. So BRSR is company centric. Double materiality is company and society centric. So it is, as said by our chairman sir in the opening speech, that it is the societal needs which have, which are the driving factors behind this particular change. Then regulatory fit, it is SEBI mandated, it is global as well as Indian regulations also require double materiality assessment. BRSR is good for compliance, but if you are looking for a strategic initiative, then obviously you should go for DMA. Investor Indian markets also requires BRSR materiality because it is part of compliance. Global as well as in Indian markets, because the aspiration of an Indian investors is also increasing day by day, and they also demand that their entity or the entity in which they are invested into should perform a double materiality assessment, whether it is future ready or future proof. BRSR mortality, we can say that is moderate, medium to moderate. And if you do a double mortality assessment, whatever impact you will be assessing, the outcome will be, if you are able to perceive the same in the right manner and spirit, it will make your organization future ready. So with these words, I'll put my deliberation to end. If we have any question, that instead of one question which I have and I received pre-session also, and that we have tried to address through the last slide of our presentation, that whether a mortality assessment can be different in BRSR and IR, the answer is yes. Whether a BRSR mortality assessment, which I have done from ESG perspective, can be used in integrated reporting, ideally it should not be. The answer is no, but still the companies are doing so. Whether the mortality state assessment or SEMA exercise which are carried on double mortality basis or for integrated reporting can be applied as it is to BRSR, the answer is yes. The fourth sub part of that query, Gaurav, before I hand it over to you, was that whether I can dilute with the reporting framework BRSR in terms of the tabular questions, etc. Yes, until unless it doesn't takes away the intent, you can very well cross reference to relevant section if the answer of that particular question of BRSR is being answered in that relevant section of your IR, MDNA, CG, etc. Otherwise, ideally, you should not. So with these words, I again convey my thanks to the chair of this committee, CA Dr. Anuj Goyal sir, for giving me this opportunity and for conceptualizing this, interactive as well as future forward looking series of webinars which we'll be conducting through CNA throughout the year. My special thanks to the vice chair of the committee for sparing time and coming out and sharing his words. Special thanks to the whole team of the committee, Secretary Anita ma'am, Nishiji, Lakshit for an fruitful as well as smooth coordination, and Gaurav for listening to me patiently along with other participants and giving such a warm introduction. Over to you, Gaurav. Thank you.
Sir, I take this opportunity to propose the formal vote of thanks on behalf of CMIB of ICI at the conclusion of today's insightful webinar. First and foremost, I'd like to thank the chairman, CA Dr. Anuj Goyal ji, and vice chairman, CA Rajesh Sharma ji, for organizing this webinar and giving us this opportunity to have a wonderful session. Secondly, I'd like to thank our esteemed speaker of the session, CA Kuldeep Kothari ji, for sharing his valuable time and expertise and his perspective with us. Your presentation was very insightful and thought-provoking. Now, I'd like to thank all the participants also for joining us today and their active involvement. I would like to acknowledge the efforts of our organizing team, the technical staff, and everyone who worked behind the scenes to make this event possible. Finally, we hope that today's session has added value to everyone's knowledge and encouraged further exploration on this topic. We look forward to your continued participation in our future events. Once again, I'd like to thank everyone. Have a wonderful day ahead.
Gaurav, you rightly said, as we discussed in Semana, that what is we see in the annual report is the outcome. So if we are sitting on the screen or we are interacting, it is the hard work of the team and the secretarial staff which makes it possible.
Yes.
Over to
definitely, sir. Thank you so
signing
much.
off. We shall discuss more relevant and interactive topics in future. Thank you, everyone.
Thank you. Thank you so much, everyone.